This is our second to last class meeting. Of course, we have the final next week on Friday. And just to review some of the conditions of that exam, it's from 10:15 until 12:15. So that gives us 120 minutes for the test. It's comprehensive in nature, but there's going to be disproportionately more points and questions from the material since the second midterm exam. So I'd encourage you to review the entire course, but the things that are especially important are those concepts since midterm 2. I'm going to provide the same equation factors that you're accustomed to seeing for time value of money problems. I'll provide a factor table if needed, and then you can bring 2 pages of notes, front and back, letter size, and you can have anything on there that you want with no restrictions. There will be questions on the exam that you have to use Excel to solve, so please bring a computer with Excel and working Wi-Fi access so that you can upload your Excel file at the end of the test. Any questions about the final exam? No more homework. You're all done with homework. You got the project done. So you're just sailing towards a successful completion. Today we're going to talk about taxes, but before we do, I wanted just to ask a couple of concept questions to whet your appetite for final exam review. So this is reaching way back into the past when we talked about how to compare alternatives that have different useful lives. So remember that we can only compare 2 options if they both occur over the same study period. And so one of the ways that we handled that was the least common multiples approach. So you remember LCM? Well, one of the things built into LCM is the repeatability assumption. So what is the repeatability assumption? Anybody remember that?
The repeatability assumption refers to if you have a piece of equipment or project, you assume that it can be replicated or purchased again.
Good. Exactly right. You're assuming that because in LCM what you're doing is you're cycling the purchase, use, and disposal of 2 options so that it lines up in the same terminal year. You're assuming that you can purchase and use the equipment multiple cycles in a known way. So the easiest is just if the price and the revenues are going to be the same in the future, but if it's not the same, you're assuming that you can predict what those subsequent cycles are going to be. All right, so that's the repeatability assumption. Would you be able to, as a short answer, offer some meaningful response to a question like that? Or if repeatability doesn't apply, what are the 2 other methods that you can use to compare alternatives? So there was LCM was one option. What are the other 2? Early termination is the other, is another. And so in the case of early termination, it's just what it sounds like. They have different useful lives. You're taking the one that's longer and you're making it shorter. And how do you make it shorter in early termination?
You sell the equipment before its life and gain a salvage value.
Good. That's right. You're selling the equipment on the market. You know, if it had some disposal value at, for example, year 8, what you're saying is, I'm going to sell this after 6 years, and hopefully it'll have more than just its disposal value. It'll have some resale value. And so you're going to terminate at the same lifespan as the shorter equipment. And so now they have the same useful life. What was the other method besides early termination?
Contracted services.
Good, contract services. And so then what's the technique there? What do you do in contract services to make the short one longer?
You assume that it can be rented out or contracted.
That's right. So you're just leasing, renting, contracting. There's some substitute where instead of buying the item outright for a lump sum, you're paying some sort of recurring fee, a lease, and then it's generating revenue during that same lease period. And so it's a way to tack on some additional years to the shorter of the 2 alternatives. ERR versus IRR. What's the main distinction between the 2? First of all, what does ERR and IRR even stand for? So yeah, E is external, I is internal, and what we're doing is comparing rates of return. So how is external rate of return different from the internal rate of return? Yeah.
The money that's your annual revenue cannot go back into the same project, it has to go into another.
Good. Yeah, so external rate of return is assuming that the money being generated by the main thing that you've done, by this business opportunity, the annual net revenue is going somewhere else. It's not being reinvested into that same project. So you have some specified external reinvestment rate. And so the external rate of return is the combination of those two things. It's a weighted average. And more than just a numerical weighted average, it's also a time weighted average because it's taking into account the rate at which the profits are generated and then the effect of reinvesting those profits in some external account that itself is achieving compounding. Internal rate of return just assumes that whatever money is generated is compounding at the rate that it was generated. So like a savings account, you can have internal rate of return apply there if the savings account doesn't force you to take the interest. If you can just leave the interest in the account and then the account continues to accumulate, then that would be an example of something for which the IRR might apply. Here's a real basic question. Why is money now better than money in the future? Why is it more valuable? Why is a dollar worth more now than it will be in 10 years?
Money in the future is more inflated than it is currently. So it is the present value has a higher purchasing power.
So what's inflated in the future specifically? It's not the money that's inflated, but you're right, something in the future is inflated. What's inflated? Prices are inflated. So that dollar in the future is competing against more dollars in circulation, which is the underlying cause for the inflated prices. So money now is more valuable because it can buy more things. Yeah.
Another way to look at it is that money now can be used to generate money. Start making money with your dollars invested now.
Sure. Yeah, I think that's another, like if you have extra money that you can invest, then yeah, investing money now has a more powerful impact than deferring that and not saving until the future. You probably saw that in your project. If you save when you're 25, it's adding up to millions. You don't start saving till you're 35, you might still get to millions, but it's not as many millions. All right. B to C method. What's the B/C method? What does B and C stand for?
Benefit cost.
Benefit cost. So you'll remember that we talked about benefit cost when we had public sector projects that don't generate revenue or that don't have a positive rate of return. So some way of trying to prioritize our spending and compare alternatives when the projects don't generate revenue. So the B2C method has one major shortcoming. Do you remember what it is? What's the hard part with the B2C method?
Is it that non-monetary benefits and costs can be quantified well?
Yeah, it's the fact that we have to somehow estimate the value of things that aren't inherently economic. Like what is the economic dollar value of a nice afternoon fishing? Maybe an economist has an idea on how to do that, but it's indirect, it's imprecise. And so the major shortcoming with the benefit cost method is that both the benefits and the costs, if we include the disbenefit as thinking of that as a cost of a project, sometimes they have actual dollar values behind them, but much of the benefit and some of the costs are non-economic, and we're just kind of extrapolating some dollar equivalent to that. So we've covered a lot of ground this semester. There's a lot of concepts out there, and I haven't written the exam yet. I probably won't do it till next week, but it could cover anything from the semester, and I'd encourage you just to thumb through the book, read through the notes, and refamiliarize yourself with some of the big ideas of the semester. My goal is for about 30, maybe 35% of the points on the final exam to be related to concepts rather than problem solving. All right, so let's talk about some unavoidable concepts. Taxes. They say the only things in life that are guaranteed is death and taxes. So there's a variety of different types of taxes, and one that we experience almost every day that we buy things are sales taxes. They vary from state to state. Some states charge sales taxes on only goods but not services. Some states don't charge sales tax at all. They can also apply at the local level. Here in Huntington, did you know that Huntington has a sales tax that's over and above the state sales tax? What's the sales tax in Huntington? 1%, that's right. So if you buy a gallon of milk in Huntington, I think it's, oh no, food isn't, you don't pay sales tax on food, so that wouldn't apply. But you buy a pencil in Huntington, you're paying 1% more for that pencil than if you buy it outside of the city limits. Sales taxes increase the cost of goods that are purchased, and so we can normally account for the effect of sales tax in our analysis just by including that in the costs. There aren't a lot of special considerations that are going to change the kinds of analysis that we do. So sales tax, we've all got plenty of experience with that. Outside of the United States, sales tax are less common. It's becoming increasingly common for governments to use value-added taxes instead of sales taxes. And in a moment, I'll tell you a little bit about value-added taxes, but it's often applied to goods and services in a similar way. It feels similar to sales taxes, but it creates some better incentives that we'll talk about. Now, an excise tax is similar to a sales tax in that it's applied to goods or services being purchased, but it usually applies to categories of items or specific items rather than just across the board. You know, sales taxes apply to everything in West Virginia except for food. And then I think occasionally there will be sales tax holidays where maybe like school supplies are excluded or back to school clothes. I'm not sure about the clothes, but I think there's a certain couple of weeks per year where you could buy a computer and not pay sales tax if it's during that back to school week. But excise taxes, rather than being across the board on all things, excise taxes usually just apply to specific categories, some of which are considered bad things and they're trying to create a disincentive against consumption. But then in other cases, excise taxes are collected because there's a need for a certain amount of revenue related to that item. So just as an illustration, sometimes tobacco and alcohol have specific excise taxes that are levied. Sometimes those are called sin taxes. You may have heard of a sin tax before, where part of the motivation there is to discourage people from smoking or consuming excessive amounts of alcohol. So some of the revenue that's collected from excise taxes are used to fund harm reduction or to fund, for example, like the health care that is incurred by governments when people smoke and get cancer and need medical care. So they try and build up or kind of recoup some of the losses that may otherwise occur from those things that have negative externalities like tobacco and alcohol. In the case of motor vehicle fuel, I mean, some people consider that as like a thing that it's better if we minimize the consumption of fuel because of the effect that it can have on pollution, like local airborne pollution, global increasing carbon in the atmosphere. So it's good to encourage efficiency, and when you have a tax on something, it incentivizes people to use less. But another really important aspect of it is that our highways have to be paid for in some way. And I saw a headline today that was saying that they're going to be adjusting the toll, the West Virginia toll road. You know, on the way to Beckley, how you have to go through a couple of toll plazas. Right now, if you just have a credit card, you're in big trouble because they only take cash or Easy Pass, as I understand it. Maybe they take checks, I don't know. But if you have a credit card, you're out of luck. But they're going to be updating that in the coming year so that you can use a credit card. But it's a nuisance. Like even if it is a credit card is accepted, I'm glad that there's only one road in West Virginia that I'm aware of where you have to pay for pay a toll because it slows you down. It's annoying. So most of the roads are just paid for by the fuel that you consume as you're driving on it. So the reason why they have an excise tax on motor vehicle fuel is to provide revenue to keep the roads up. And of course, the problem is when like a hybrid car or an electric car isn't contributing much to the fuel taxes, and then it still is putting a demand on the road. So a couple of years ago, the legislature imposed a higher registration tax on hybrids, and I think even higher on electric vehicles to try and recoup some of the lost tax revenue they would have gotten from gasoline burning vehicles. Airline tickets, they have special excise taxes there to help fund the FAA, flight traffic controllers, ground operations, and so on. Of excise taxes, there are two main categories. Those that are levied on a percentage basis, the ad valorem taxes, where, for example, if you use indoor tanning services, the IRS charges 10% as an excise tax. And a lot of times you don't see that excise tax, just the provider pays it, and they make it invisible to you. So for example, 10% tax on firearms. When you buy a gun, you do pay sales tax, but there isn't a separate line that says 10% excise tax. It's just the dealer pays it and is adding that in when they're charging you for the item that you purchase. So there's 7.5% tax on airline tickets, 12% on trucks, and it goes on and on. So that's ad valorem. Specific excise taxes, rather than being a percentage, there's a fixed dollar amount that applies. And so, for example, the federal tax on cigarettes is $1 per pack. Each state also has a separate excise tax on top of that, and it varies quite a lot from state to state. The federal government has a gas tax. States also have a gas tax that are specified on cents per gallon, cruise ship passengers, and so on. So that's an excise tax. It's a certain item. It's not always a negative item, but frequently they're levied because there are some specific costs related to that thing that the government doesn't want to just use a general revenue fund to pay for that item. They don't want to just use like income tax to pay for a cruise ship terminal improvement and the immigration and customs at a cruise ship terminal. They figure that they'll just charge the people who are using that service. And so that's the idea behind an excise tax. We'll talk more about income taxes on Friday, but just as a category of taxes, you pay income tax on the personal level. It's the income that you make from working, and in the case of businesses, it would be their gross revenue minus deductions. And so deductions are including the expenses that they incur and depreciation. Income taxes can be applied at the federal level, states, some local governments also apply income taxes. Not all countries have income taxes. I used to live in one that didn't have any income tax. The UAE, when I lived there, didn't have any income tax. And it didn't have any sales tax or value added. There was no taxes there. Occasionally there were a couple of fees, but it was pretty cheap to live there because they were just funding their government operations mainly with oil revenues. Income taxes are progressive, and we'll talk more detail on Friday, but that just means that the more money you make, the higher your income tax rate gets. So if you're relatively low income, your base tax rate is 15% at the federal level of the taxable income. But as you have a higher income, it goes from 15 to 18 to 21 and so on. And then the other major category of taxes I want to touch on are property taxes. And property taxes are unique in that if you're a business, you have to pay property taxes even if you aren't generating any revenue. So you don't have to pay income taxes if your company's losing money. If you have no profits, you pay no income tax. But even if you're not profitable, you do still have to pay property taxes. And so property taxes in some places are only applied to real estate. Other places it's applied to personal property or equipment, like big key machine items. So independent of output just means that even if your company is losing money, the property taxes still have to be accounted for as a fixed cost. Yeah,
Property taxes based off of the original value, or are they based off of depreciating?
it's based on depreciating. So as your car, for example, here in Cabell County, as your car is older and older, your property tax on that vehicle goes down. Yeah. And we're going to look at the property tax rates in the county just as an illustration. So it's interesting to compare from state to state sales taxes. So here in West Virginia at 6.57%, that's relatively low. We're 31st in the nation. So number one would have the highest taxes. And I don't recall, I guess that's, yeah, I don't remember who's number one. Anybody see it?
Tennessee.
Tennessee, number one. Yeah, I'm surprised. You know, Tennessee's kind of a conservative state. They're usually a little bit less on the taxes. But when you have lower...
Income tax though?
No, this is only applying to sales tax.
Right, that's what I mean. I think they have a higher sales tax.
Yeah, they probably reduce, hopefully, in other areas. There are certain states that are known for having high taxes just overall, like California and New York. They're both relatively high on the sales tax. They also have high state taxes. They also have high excise taxes on fuel. They also have high cigarette taxes. They just have high taxes overall. Some other states, though, do balance it one way or the other. Yeah.
It's kind of hard to see, but what's the gray mean?
Gray means no tax.
Oh, okay.
Yeah, so Delaware, New Hampshire, Montana, and Oregon, no sales tax. So what do you think is the incentive for somebody who lives in Vancouver, Washington, which is right across the river from Portland, Oregon? If you're going to buy a computer, where do you buy your computer if you're a resident of Vancouver, Washington? You go over to Oregon, you buy your computer there, right? It's cheaper. Now, you couldn't go buy a car because they don't let you avoid sales tax on major items. But I'm sure there are lots of people in border communities that go back and forth. I know that's the case. I have a brother-in-law that lives just across the border from Geneva, Switzerland. He lives in Annemasse, France. And he said all the Swiss people will go grocery shopping in France because the prices are lower and the taxes are lower. But there's a really strict rule of how much food they can take back into Switzerland at any given time. So you'll sometimes see someone pulled over for a spot check and the police are going through their groceries to see if they went over the limit of how many sausages you're allowed to take across the border. So people will always look for a way to avoid tax. Gasoline taxes are interesting. If you look at California, they pay 78 cents a gallon for their fuel tax, whereas here in West Virginia, we've only got 37 cents. And I always notice when I go to South Carolina, because I go there occasionally to work on the Fundamentals of Engineering exam, their fuel taxes are even lower, only 28 cents a gallon in South Carolina. So Alaska is an oil-producing state, and they don't like high fuel taxes. They only have 8.95 cents per gallon. So it's really cheap in Alaska, the fuel there. So remember that the reason for this excise tax is to help maintain roads when it comes to the gas tax. So states get some money from the federal government, comes back to them for roadway maintenance, and then they also collect their own revenue. But in almost every case, it's not enough. There's this account for highway maintenance. The amounts keep going down every year. It's, I guess, a good problem to have, the fact that people are consuming a little bit less gas because cars are becoming more fuel efficient. People are switching over to electric and hybrid vehicles, which are more efficient. But the funds that pay for highway maintenance are getting smaller and smaller, and so people are having to get creative to figure out how to keep roads maintained. Cigarette taxes, another interesting figure because it just varies so much between, like New York, for example, where in addition to the state tax, in addition to the federal tax of about $1 per pack, the state tax is $4.35. So even before you're paying for the cigarettes itself, just the tax is $5.36 in the state of New York. Whereas some of the tobacco growing states, states that have a longer history of agriculture and growing tobacco like Missouri, Virginia, much, much lower cigarette taxes there. And so what happens when you've got a high tax state like New York and a relatively low tax state like Virginia, just a couple hours drive away, is smuggling. It's a real problem where people will load up vans or trucks full of low tax cigarettes. They'll go to New York and then have kind of a black market sale of untaxed cigarettes. And that's what this figure, it's hard to see, but it's just the Tax Foundation did a regression analysis looking at how much an increase in cigarette taxes is associated with increased smuggling rates. So it's kind of interesting. There definitely is, in states with high tax, there's more smuggle, like a greater percentage of the cigarettes in that state have been smuggled in. Whereas there wouldn't be any incentive to smuggle in untaxed cigarettes in Missouri because they've got the lowest in the nation. All right. A lot of states have imposed excise taxes on vaping. And it's interesting to see that in some cases it's a percentage, and in other places it's a flat, cents per milliliter. So just comparing, for example, Colorado, 30% of the manufacturing price. Some places do it on wholesale. And then other places have it in terms of a cartridge, in terms of milliliters. So there's always going to be some way to try and avoid the tax. For example, in the case of New Mexico, if it's 50 cents per cartridge, they'll just have these big drums, I guess. Like it'll be more, to avoid the tax, more economic incentive to have the big vape cartridges instead. Okay, if we look at the total excise taxes on a per capita basis, this was data from 2015, but in West Virginia, our cumulative excise tax taking into account fuel, insurance premiums, public utilities, then West Virginia is pretty high, 6th in the country at $787 per year in excise taxes. And a lot of people say that excise taxes are unfair to the poor because a greater proportion of their income is being spent on these taxes than someone who has a high income. Then it's easier for them to bear the cost of excise taxes. And so unlike income taxes, sales tax and excise tax is not considered progressive. All right, so let's talk about how a value-added tax is different from a sales tax. A sales tax is only applied in the final transaction. The person who manufactured an item doesn't charge a sales tax to the wholesaler. The wholesaler doesn't charge a sales tax to the store that's going to sell it. The only time a sales tax is collected and paid is from between the retailer and the end consumer. Whereas a value-added tax, everyone in the chain pays a portion, carries a burden of taxation. And so value added just means that in each step, somebody is doing something useful, and that's why they're able to buy it for a low price and sell it for a higher price. Whether the useful thing that you're doing is marketing or transporting an item, or if the useful thing that you're doing is having it on a shelf and making it available to people, every step in a chain, somebody is serving a function that allows them to charge more than they bought the item for. And so the way that a value-added tax is, it applies as a percentage of how much additional value your step created in the process. And so this illustration just shows if you're going to make a shirt and you're starting off with a farmer growing cotton, how each person is paying their share of the tax rather than only having the consumer pay the tax. So the idea with the value-added tax is it's more fair because everyone is carrying the burden of the tax rather than just the end consumer. And so that makes it less inequitable. It's more of a progressive tax if everyone's carrying the burden of it. And a value-added tax compared to sales tax also helps to avoid tax. It helps to prevent tax avoidance. So step one, the farmer grows cotton and sells it for $1. And so this assumes that they started with seeds that have no value. I guess seeds left over from last year. So they're going from $0 in value to $1 in value. So they actually collect $1.10 from the person they sell it to. They keep the dollar and they give 10 cents to the government, because that's the government's share, is 10% of the value that they added. So the textile maker bought this cotton for $1 and is going to sell their item for $5. When they sell it, they actually charge $5.50. So it's the amount that they're going to keep plus the 10% tax premium. So what they're doing is they're going to reimburse themselves for the 10 cents that they paid in the purchase of the cotton, because the net price that they paid was $1.10 when they bought the cotton. So they're reimbursing the previous tax that they paid, and so they're only going to pay the government 40 cents for the value-added tax. But when we get to the end, all the cumulative value-added tax for all the steps in the process will add up to 10% of the final item's price. So step 3 is somebody's making a shirt out of the textiles. They sell it for $12 plus 10% of that is $1.20. So that means that the person who's the retailer that buys that finished shirt has to pay $13.20. The clothes maker keeps $12 plus they're reimbursing themselves for the 50-cent tax that was paid in the previous step. So that means the net tax amount that they give to the government is 70 cents. And then you can see the final step follows that same pattern, where if the item is selling for 20, you collect 22 because that's the purchase price plus 10%. They reimburse themselves the previous $1.20 in tax that was paid, and so they're only paying tax on the difference between what they bought the item for and what they are selling it for. So in that case, it's 80 cents of tax that they paid, and then adding it up through the whole process, $2 in net tax was collected from all 4 steps. So it seems complicated, but you don't have to see the whole global view. You just have to keep track of what you bought and what you sold. And so for each individual person, it seems simple enough, but it creates more equity, and the economic incentives don't discourage consumption in the same way that they do if only the consumer is carrying the entire burden of that tax. All right, so let's talk about property taxes. And the Cabell County assessor has the tax rates online. And I noticed today when I was looking at their website that there's actually a discrepancy between what they have on this page and something they have somewhere else. But if you live in Huntington, you'll pay higher taxes than you would in a rural area like Ona. So class 2 is the tax rate it's a percent. So 1.7112% of the property assessed value has to be paid if it's owner occupied. So class 2 is if you're living in a house and you're the owner of it. If a property is occupied by renters, then the tax rate is higher. And this is actually pretty unfair, because what the landlord is going to do is just pass that along to the renter. And so someone who doesn't own their home is actually paying more in property taxes than people who do own the home. And I don't know, like, what's the moral justification for that, but that's the practical effect, is that owner-occupied homes are taxed at a lower rate than rental properties. And the same thing is true in rural areas. Class 2 applies to Owner-occupied class 3 applies to occupied by renters. The other urban areas, with quotes, besides Huntington is Barbersville and Milton. So those, Barbersville, Milton, and Huntington are the only cities in Cabell County. And then there's the rural areas as well. And each of them follow this pattern of a certain percentage being higher for the renter occupied. So there's somebody, the assessor goes to homes and figures out how much they think the home is worth. They do an appraisal, looking at the square footage, the quality of the construction, how improved the site is. They come up with some standard procedure they apply to all the homes and businesses in the county, and they figure up the appraised value. 60% of the appraised value is the assessed value. I don't know why they bother distinguishing between the two, but they do. And then once you have the assessed value, you take the rate that we were just looking at on the previous website page, divide that by 100, multiply it by the assessed value, and that's the amount of property tax that you have to pay. So just as an illustration, if there's an owner-occupied home in Huntington and this rate of 1.652 applies, then if it was appraised at $150,000, the assessed value would be 60% of that, which is $90,000. And so the property tax would be $90,000 times 1.65%. So it would work out to about $1,500 per year. Okay, I have a in-class exercise where we're going to actually look at a couple of interesting data sources. Because we're running low on time, I think what I'll do is I'll just go to one of them so you don't have to look it up. Let me go to the budget, the legislature's budget. It's a long document. I'll just show you the part that we're trying to find in there. Okay, so this first part of the in-class exercise is just saying, okay, obviously our gas tax isn't enough. Our gas tax isn't enough to cover all the cost of the highway department. So how are the other ways that we could provide that? So this is the current budget. And if we go to page 85, they're going to have how much the highway department's share of the budget is. So here it is, the Department of Transportation, Division of Highways. Okay, so the Division of Highways, their budget for the current fiscal year 2024, is $1.6 billion. So question one was asking, what is the total budget for the Division of Highways? It's $1,630,574,687. So that's their budget this year. Now that's just their baseline budget. They also have some special funding that's come in for the bipartisan infrastructure law. 2 years ago, there was a big $550 billion investment that was made in refurbishing infrastructure in the United States, and a portion of that will come to West Virginia, but that's not their operating budget. This is their operating budget. So what this is asking in the in-class exercise is, if this is how much money they're going to spend this year, what if you needed to just collect that through vehicle registration? How much would you have to charge to provide that entire budget on the basis of 700,000 registered vehicles in the state? Okay, so if you are spreading it out equally and every vehicle that gets registered pays the same amount, and if you were trying to cover the whole DOH budget just with vehicle registrations, I think that it would be about $2,300 per vehicle is how much you'd need to collect. Has anybody actually registered their car in West Virginia? Is it that much?
53.
It's way less. Yeah, it's 53. If you've got a hybrid, maybe 103. Yeah, so honestly, I don't know where they get all the money for that $1.6 billion because it's definitely not just from the gas tax, as we'll see in a minute from the next question in this, and it's definitely not from vehicle registration. I think probably there are some of the general funds that are related to income taxes are helping to support the division of highways as well. All right, so this would be an example if it was collected on a dollars per vehicle basis, then that would be an example of an excise tax. You know, a specific tax that applies per item and the revenue is being used for a specific purpose like highway maintenance. What if it was based on gasoline? So this next question asks, what if we have 1.8 million people in West Virginia and each person is consuming 458 gallons of gasoline per year? That's per person, not per family. That's not per vehicle. That's per person. Then how much would the gas tax need to be if we were trying to do the same thing, trying to collect all of that $1.6 billion, but just in the gas tax that was being collected? So for this one, we got to calculate how many gallons of gasoline are being consumed. So it's 1,844,000 people, each of whom is using 458 gallons. Then statewide, it's 844 million gallons of gasoline per year being consumed. So what you do is you distribute that $1.6 billion over the 844 million gallons of gas. So the fuel tax would have to be $1.93 per gallon. And that's way more than we're actually paying. I think our fuel tax, if we just skip back to that earlier slide, our gas tax in West Virginia is 37 cents. So that kind of illustrates that it's not just gas taxes that are paying for the Department of Highways budget. They're getting revenue from a variety of sources. They're getting it from vehicle registrations. They're getting some of it from toll roads, some of it from gas taxes, some of it probably just from the general fund. There are places where they collect all of their highway revenue from fuel taxes. I visited, the highest fuel tax I've ever paid was when I was in Iceland. And they have, in Iceland, around 400,000 people in the whole country. And the country is roughly the size of Ohio. So people are really spread out. And they've got great roads. The roads are in beautiful shape, but you pay more than $7 a gallon for gas in Iceland. It's really expensive. And it's not all just the cost of the fuel. Most of what you're paying when you spend $7 a gallon on gas in Iceland, most of what you're paying is taxes so that they can maintain the roads. Okay, the last part of this is let's look at the Cabell County Assessor. So let's go back to the Cabell County Assessor website. And this question is asking if you had a rural area owner occupied, how much would the property tax be for a $200,000 home? So rural area, owner occupied, the rate is 1.3912. So the calculations to find out how much is the home going to cost in taxes is you would take the 200,000, multiply it by 60%. So the appraised value is 200,000. That means the assessed value is 120,000. And then for a rural area class 2, multiply that $120,000 by 1.3912%, and that means that the tax would be $1,669.44. That would be the tax on a $200,000 appraised home. The error that I noticed on the Cabell County Assessor website is like these values that it shows, these percentages, it's a little bit different from a calculator that they have online. Let me show you the calculator. If you scroll down on their website, they've got a tax estimator page that's interesting to look at because then it tells you where your money is actually going. And you may have heard that there's a big lawsuit and grudge match going right now between the library and Cabell County Schools. Has anybody heard about that? Cabell County Schools basically said that they were going to keep all of the property tax money. They're supposed to give some to the libraries, but they said no. So it's going through a lawsuit right now. So if you had a $200,000 home, you can calculate what your taxes will be, and this will also show where it's going. So the discrepancy I noticed is that this rate, 1.3736, is a little bit different from the rates that they show earlier on the website. So I'm not exactly sure which one is right. But here it shows you, when you pay $2,000 in taxes, where's it going? A certain amount of it is going to the health department, a certain amount is going to fire protection, emergency services, and so on. So that always makes me feel a little bit better about paying my property taxes when I can see the agencies that it goes to. That's all the time we have for today. On Friday, we'll talk more about taxes, and so I'll see you then.